In 1969, one company accounted for 1% of everything America bought. Today, Sears has been reduced to a fraction of its former scale. The company's current state is characterized by closed locations, reduced operations, and the closure of its last store in Illinois in 2021. Sears previously served as a major force in American retail. It provided rural consumers with access to a wide range of products and contributed to the development of suburban shopping centers. It offered everything from basic goods to more significant purchases. Its decline was substantial, exceeding what might be expected from market competition alone. This outcome resulted not primarily from disruption by external competitors, but from internal strategic decisions. The company benefited from a long period of accurate market timing and execution. This was followed by decades of challenges in adaptation, leadership assessment of market conditions, and organizational tendencies toward overconfidence and resistance. To change, established companies often contain internal factors that can contribute to eventual decline. In Sears' case, these factors developed over approximately 70 years. The central issue is not only the specific causes of its decline, but why its leaders continued to operate under the assumption of ongoing success while observing the company's weakening position over time. The company's origins date to 1886. Richard Sears, a railroad agent in Minnesota, received a box of watches that a jeweler had refused. He recognized an opportunity and sold them to other agents at a markup. He then expanded by offering similar products to rural customers in the Midwest through mail order. By 1887, Sears had moved to Chicago and partnered with Alva Roebuck, a watchmaker, after placing a classified ad. The collaboration combined Sears' business drive with Roebuck's technical skills. In 1893, they incorporated the business as Sears, Roebuck & Co. The main tool for growth was the catalog, which functioned as more than a list of prices. It provided rural consumers with access to products that were previously difficult to obtain. In 1895, Julius Rosenwald joined the company. As a clothing merchant, he brought financial and operational discipline. He acquired Roebuck share and implemented structured processes. The company emphasized customer trust through strong guarantees, including satisfaction or money back. It took advantage of infrastructure improvements such as rural free delivery in 1896 and parcel post in 1913 to expand delivery capabilities. By 1906, Sears constructed a large distribution center in Chicago, which was the largest of its kind at the time and enabled high-volume order fulfillment. Richard Sears handled much of the catalog copy, using direct and engaging language. Rosenwald managed operations and finances with precision. Together, they addressed a key challenge in 19th-century America: the isolation of rural populations. The catalog offered not only goods, but also access to a broader range of options at competitive prices. However, the foundation of Sears' early success relied heavily on specific market conditions and building customer trust. When those conditions changed and trust levels were affected, the company struggled to develop new strategies and instead maintained its existing approaches. In 1924, General Robert E. Wood joined the company, drawing from his experience in Army logistics. He identified that the catalog-based model was losing relevance as America urbanized and suburbanized and as automobile ownership increased. He led a strategic shift toward physical retail stores. The first store opened in Chicago in 1925. Within 5 years, the company had opened 300 stores. By the 1930s, the number reached nearly 700. Wood's approach emphasized strategic location in suburban areas with ample parking and the concept of one-stop shopping. The company developed private label brands that gained strong market recognition, including Craftsman tools introduced in 1927, Kenmore appliances, and DieHard batteries. In 1931, Allstate Insurance was established through the catalog channel. Sears positioned itself as providing complete lifestyle solutions rather than individual products. Following World War II, growth accelerated as young families moved to the Sun Belt. Sears became the anchor tenant in many new shopping malls. By the 1950s, operations extended to Mexico and Canada. In 1967, monthly sales reached $1 billion. The catalog business generated $4 billion annually by the 1980s. 2/3 of Americans shopped at Sears at least once every 3 months. Half of them carried the Sears credit card. The company's brands held 41% of the U.S. appliance market. Management practices were highly structured. Managers received training similar to military preparation and a comprehensive 29,000-page policy, manual guided operations. Executives tended not to attend external industry events, reflecting a belief that the company possessed all necessary internal knowledge. The completion of the Sears Tower in 1973 symbolized the company's stature. By 1975, Sears, along with Penny and Ward, accounted for 43% of department store sales. The company functioned as a central element in the American retail and consumption system. However, this level of market dominance contributed to reduced sensitivity to emerging competitive threats. When discounters such as Walmart, Kmart, and Target entered the market in 1962, Sears leadership viewed their low-price limited service model as not relevant to their core customer base. This assessment proved to be a significant miscalculation regarding future market evolution. During the mid-1960s, Sears held a dominant position in retail. Its market value reached the equivalent of $92 billion in current dollars. Sales represented 1% of the entire U.S. economy. The scale of the company allowed it to influence areas such as postal services, suburban development, and insurance regulations. Sears reflected broader American consumer patterns. Families purchased major household items, tools, and financial products from the same retailer their parents had used for smaller purchases. The catalog served as an early form of curated product selection delivered directly to consumers internally. Decision-making was centralized with strong discipline, but also high levels of confidence. Successors to the earlier leadership inherited a highly profitable operation. Store conditions were well maintained, customer service standards were high, and credit terms were accessible. The combination of catalog, stores, private brands, and financing created a self-reinforcing cycle that generated substantial returns by 1975. Sears, together with Penny and Ward, controlled nearly half of the department store market. Competitors remained fragmented. New malls were frequently designed with Sears as the primary anchor tenant, providing significant real estate advantages. This period of peak performance, however, also established conditions that limited adaptability. As economic factors such as inflation emerged in the 1970s and consumer preferences divided between price-focused and specialty-oriented segments, Sears maintained its established positioning. Leadership, operating from within a large and successful structure, had difficulty recognizing the extent of the market shifts. The perspective from senior levels presented a consistent but incomplete view of the changing environment. The competitive challenges facing Sears were evident but not adequately addressed by leadership. In 1962, Walmart, Kmart, and Target entered the market. Sears regarded these new discounters as operating in a lower segment and not direct competitors. During the 1970s, inflation contributed to a division in consumer behavior. Price-sensitive customers shifted toward discounters, while higher-income consumers moved to specialty retailers. Sears remained positioned in the middle market, with pricing and offerings aligned to earlier decades. Internal indicators provided early warnings. Same-store sales growth slowed, and catalog profitability decreased. However, company analysis attributed these trends primarily to broader economic conditions rather than internal strategy or positioning. Data also indicated that the core customer base was aging. In response, the company increased its reliance on profits from the credit operations, which accounted for 60% of earnings by the early 2000s. Competitors advanced their capabilities in data analysis and supply chain management. Walmart, for example, implemented advanced inventory systems using computers, while Sears continued with averaged cost calculations across its operations. Although online retail had not yet emerged fully, the advantages of scale and convenience and efficiency were becoming apparent. The fundamental limitation for Sears was organizational. Its prior success had become closely tied to its identity. Acknowledging that the core model required fundamental updates would have implied that the previous approach was no longer sufficient. Instead of core adjustments, the company pursued diversification strategies. The first major internal limitation emerged in the boardroom in 1954 when General Wood retired. The board appointed for successive CEOs, each selected for stability and each retiring at age 65. This resulted in 20 years of cautious, incremental leadership with limited introduction of new perspectives or disruptive ideas. By the 1970s, the company's culture had become highly rigid. The 29,000-page policy manual restricted local initiative. Cost accounting practices remained outdated, preventing managers from identifying which departments generated or lost money. Overhead costs were elevated and difficult to control. In 1978, CEO Edward Telling determined that the core retail businesses were insufficient for continued growth. Rather than addressing retail operations directly, the company pursued acquisitions. In financial services, including Dean Witter and Coldwell Banker, leadership anticipated synergies through cross-selling, but these failed to materialize in practice. Retail operations increasingly served as a funding source for the financial units. Authority gradually shifted from merchandising experts to finance-oriented executives. Store managers observed headquarters treating retail performance as a balance sheet item rather than a core operational focus. Employee morale declined, and key talent departed. The organizational mindset became one in which the company that had once executed large-scale projects could no longer implement even minor changes without extensive committee review. This institutionalization of caution and internal focus prevented timely responses to external market signals and reinforced a pattern of denial regarding the need for structural change. The company's decline accelerated through a series of specific, strategic decisions executed over time. From 1981 to 1992, Sears expanded aggressively into financial services. It became the largest financial services company by revenue on paper. In practice, the Dean Witter offices located within stores operated at a loss for 4 consecutive years. Promised synergies did not develop. Retail operations received reduced capital investment as resources were redirected. Market value declined 66% from its 1965 peak. In 1991, Walmart surpassed Sears as the largest retailer in America. Leadership responded by stating that the company competed directly on only 30% of product categories, thereby maintaining its existing strategy. In 1993, the company discontinued the Big Book catalog. This removed the original engine of data collection, customer trust, and cultural reach without implementing a comparable digital alternative. In 2002, Sears acquired Land's End for $2 billion, only to spin it off in later years. In 2003, the credit business was sold to Citigroup, generating $32 billion in total proceeds. The transaction provided short-term cash, but removed a major profit contributor from the core. Retail structure. In 2004, hedge fund manager Eddie Lampert acquired control for $11 billion and merged the company with bankrupt Kmart. The transaction was framed as strategic, but functioned primarily as an asset-oriented investment. Lampert implemented 5 key operational choices that shaped the subsequent trajectory. First, he exercised direct micromanagement from a remote location. This paralyzed decision-making at the store level. Second, he prioritized quantitative metrics over qualitative market trends. Spreadsheet analysis took precedence. While customer migration to competitors with superior store experiences and online options continued. Third, confirmation bias influenced executive retention. Dissenting voices typically lasted only 12 to 18 months, producing a revolving door of 5 CEOs in 8 years. Fourth, real estate assets were retained rather than monetized through a REIT structure at peak valuations. Brand assets, such as Craftsman, DieHard, and Kenmore, were sold individually instead of leveraged for competitive advantage. Fifth, despite 0 same-store sales growth since 2010, leadership insisted that a turnaround remained imminent. Store capital expenditures were minimized. Layouts remained unchanged from the 1990s. Staffing levels were reduced, and maintenance was deferred. The in-store experience became more challenging for customers. Online capabilities received minimal investment and were treated as secondary to physical retail. Each decision produced rational short-term financial outcomes, yet proved detrimental to long-term viability. The cumulative effect was a self-reinforcing cycle in which reduced investment led to weaker performance, which in turn justified further reductions. From 2010 onward, the company reported no consistent profits and relied on accounting measures. To manage reported results, store numbers declined from more than 3,500 to under 900. Same-store sales decreased between 7% and 15% annually. In 2013, Lampert assumed the CEO role. Between 2014 and 2017, store closures occurred in multiple waves. Approximately 50,000 jobs were eliminated. Headquarters staff was significantly reduced. Loans from Lampert's own investment fund sustained operations at high interest rates. In 2018, the company filed for Chapter 11 bankruptcy. It had recorded $11 billion in losses since 2011. More than 725 stores closed within 2 years. Lampert submitted a $5.2 billion bid to retain control of the remaining assets. The bankruptcy court approved the plan, yet the brand's market relevance had already eroded substantially. The final phase involved the progressive reduction of physical presence. Anchor locations in malls stood empty, while signage remained visible. The last Chicago area store closed, followed by the final Illinois location in 2021. Employees completed the shutdown procedures as external investors evaluated the residual brand assets that the company had originally developed. The organization, that once processed 100,000 orders daily from a single distribution center, now operated with fewer than 30 full-line stores. The sequence of events demonstrated how prolonged underinvestment in core operations, combined with asset-focused financial management, produced an irreversible contraction of the business model today. Sears operates as a limited entity. A small number of stores remain open, primarily focused on appliances and mattresses within declining mall locations. The website continues to function at a reduced scale. The original private label brands have been dispersed. Kenmore appears on Amazon, Craftsman at Lowe's, and DieHard at Walmart. Lampert's ESL Investments retains control of the corporate shell. Ongoing litigation addresses allegations of asset stripping. The Hoffman Estates headquarters property was sold and is undergoing demolition. The Sears Tower in Chicago was renamed Willis Tower and sold in 1994 to address debt obligations. What remains is primarily institutional memory and a documented example of how market leadership can erode through sustained internal decisions. The case continues to illustrate the consequences of prioritizing short-term financial extraction over long-term operational investment. Sears illustrates a central principle in business strategy. Sustained success can create conditions that hinder future adaptation. It fosters the perception of permanence, rewards maintenance of existing capabilities, discourages dissenting analysis, and converts accurate historical timing into a sense of entitlement. Several operational patterns emerge. Clearly, integrated business systems lose momentum when treated as funding sources rather than areas requiring ongoing investment. Sears extracted value from retail to support financial services, which weakened the foundation. Extensive customer data provides limited value without corresponding insight into evolving trends. Sears possessed superior data, yet did not act on its implications. Organizational confidence can evolve into a structural barrier when it suppresses external perspectives, as seen in the detailed policy manual and remote decision-making. Timing determines advantage only when paired with continuous reassessment. Sears executed early shifts with precision but missed subsequent market transitions. Finally, concentrated authority without accountability mechanisms can shift focus from value creation to asset management. This pattern appears across industries when leadership fails to align internal structures with external changes. The outcome for Sears was not inevitable from market evolution alone, but from the refusal to recalibrate strategy in response to observable shifts. What strategic adjustments would enable other market leaders to avoid a similar trajectory in their own sectors?